Hey, good morning, everyone. Marty Mazzora here, May 7th, 2025, with your midweek update. Going to keep it relatively quick today. I want to share a few highlights from our notes of the past few days, talk about the setup, look at the charts, and so forth. On your screen, you notice I have live Jerome Powell speaking in the press conference after the Fed's decision today to leave interest rates unchanged. And with no disrespect to Mr. Powell, I think we've heard all we need to hear and seen all we need to see so far in terms of market reaction. And one thing of note, though, is the statement itself and what he reiterated in his monologue, and that is that the Fed sees both higher risk to rising unemployment and a higher risk of rising inflation, both at the same time. Now they have this dual mandate of stable prices in the economy, i.e. keep inflation moderated, and full employment, i.e. keep the economy chugging along, as if the Fed can single-handedly do that. So their job is a tough one at this point. Their task is ominous. I will be very frank to tell you I am no big fan of the Federal Reserve, or at least the way they have operated things. My candid view over the decades that I've been doing this is the Fed sees themselves as existing to keep financial markets buoyed, or I should say that what they believe is the right policy, in effect, do that. And the end result being massive wealth inequality, because you're keeping asset prices buoyed, you're keeping interest rates at times artificially low through what's called financial repression. And you can get away with that for a long time as long as inflation is kept at bay. Now, inflation expectations among consumers is very high going forward, and they pay a lot of attention to inflation expectations as well as, the data as it comes in. This is not your 2019 setup, in our view, when the Fed was concerned about rising unemployment, was concerned about the economy, and this is just before COVID. This is before anybody knew about COVID or knew it was coming, of course. And they started cutting interest rates in response to what they saw as economic weakness. At the time, they did not have inflation to contend with. Today, I believe they are going to be reluctant to be aggressive because of the inflation overhang. Now, having said that, what I mean is I don't think they're going to be preemptive. I think they're going to wait for the data to really deteriorate before they start cutting interest rates. Now, the market is anticipating that. Right now, priced in between now and the end of the year is 3 rate cuts, you might say 3 to 4. So Fed funds futures, anyway, are pricing in a notably weaker economy, maybe even a recession that the Fed's going to have to react to. But again, the Fed made right up front the statement that they see inflation risks rising as well. So again, put those two together, rising inflation and rising unemployment, and the term is a ominous one, if you will, and that is stagflation, a stagnant economy with inflation as a challenge. So we'll see. I don't know that that's our base case. Our base case actually is that we will finally see that recession and that it will finally come in 2025, or at least that's when it will begin. And again, when I say that's our base case, that doesn't mean it's 100% our expectation. It just means better than 50-50 odds, and something that we have to express, or a position of ours that we have to express within our client portfolios to mitigate the pain of a recession. And I say that because this market is not discounting that possibility just yet. I do think that we are seeing some real complacency and some hope priced into these stock prices. So with that very thing in mind, here's this morning's note. And essentially what I say here is that BCA in this message echoes what I talked about in the video the other day, and it was about the soft data getting softer, but it wasn't really reflected in the hard data as of yet. So soft versus hard data, the confirmation trap. This is just their quick commentary on that. Markets no longer trade on soft data fear. They now wait for hard data proof, keeping us defensive on risk assets. That's BCA's recommendation, is to be defensive. Friday's payroll beat, meaning the jobs number was better than expected, heightened the soft-hard split, the payroll data being the hard data. Surveys flag weakness, but actual jobs hold up. In past cycles, markets priced ahead on soft data momentum. Today, they demand confirmation, delaying the pricing process or the repricing process and masking fragility beneath the surface. That's our concern. Ahead of the May 15th retail sales print, which is coming in 8 days, investors should refine how they read soft data. Our objective soft data indicator closely foreshadows real GDP. Its latest readings point to growth slipping below potential, hinting at weaker profits and rising credit stress later in the year. Risk assets have not priced this risk. You've heard me say that multiple times over the last few months. As employment edges higher and consumption cools, market will have to absorb a deeper slowdown than currently discounted. Meanwhile, the Fed is staying focused on inflation, not growth, limiting policy support. I don't know that they're entirely focused on inflation, not growth. I do think that when growth really begins to show up as slowing in the economy, you're going to see the Fed cut rates. This from BCA, it certainly has a more deterministic bent than what I'm willing to say, meaning they sound very confident in their assessment that things are going lower. I have been humbled too many times by this market over the years, so I'm not going to sound that confident. I am just going to say that probabilities are leading in that direction, and therefore we need to be smart with our asset allocation going forward. And lastly, this has to do with the dollar. Back in 2018, the dollar actually rose by like 10% to offset the trade war with China in particular. So the dollar strengthened against the Chinese currency, and that, in effect, pretty much muted the negative effects of the tariffs. Scott Bessent said that for every 10% tariff increase, we are going to see a 4% increase in the dollar index. Well, I'll show you the chart here in a minute. The dollar's gone in the opposite direction. As the tariffs have increased, the dollar has actually declined, and we talked about that. We talked about an exodus from U.S. equities into places like Europe and other parts of the world being a weight on the dollar, and then this whole kind of belief or this sense that the U.S. is not going to be the place to invest your capital as much in the future. So you're getting some weak sentiment toward the dollar and so forth. It wouldn't surprise me to see the dollar pop as things get more uncertain, if things slow down and people start buying treasuries, which is typical during recessions. We're going to be running big budget deficits, though, so it'll be interesting to see how much we actually see that traditional move lower in yield. Some would argue that this is different this time. Of course, we'll have to wait and see. But that could provide some upward oomph for the dollar. Longer term, we are solidly in the lower dollar camp, and we expect to do very well investing along that thesis during the next cycle. Still got to get through the end of this one first. I'll stop with this one. Guidance getting grim, and this is earnings guidance going forward. The talk on tariffs did little to rattle the S&P, surprisingly strong earnings in Q1, but the impact is showing up in guidance. Falling to 10-year lows, and estimates plunge for the rest of the year. So companies are saying, hey, we hung in there during the first quarter, but going forward, we have problems. And so guidance is turning down. Gina Martin Adams, who I used to think was a perma-bull with Bloomberg, is now starting to sound very bearish. Suffice to say, folks, that as this implies, and as I've been saying, I'll repeat for months now, this market is very, very hopeful and is just not willing to price in the kind of pain that would come with a recession. And we may not get one. I think if this trade war goes away and animal spirits come back, what the inevitable recession, and we will get one because I still believe in the business cycle, could get pushed off, could get even pushed off into 2026. So nothing is certain in this world other than uncertainty, if you'll allow me. So right now, as I speak, again, I wasn't listening to Chairman Powell, but the market was positive for most of the day. The S&P is now down 20 basis points, 0.2%. The NASDAQ is down a little more than 0.5%. I think the Dow is still holding up. Dow's up 130 points. There must be a component or three in there that actually is bucking the trend. Kind of a lackadaisical, no big reaction just yet to anything that Chairman Powell has said. In fact, as I'm speaking to you, the VIX is now dropping. It's now down 0.25%. The S&P is pretty much flat. So anyway, so not much to go on there. Just as I said the other day, 100% headline-driven market. Volatility is going to be high in both directions going forward. What we're waiting for now is the data to come out over the next few weeks and months and give us guidance as to how this is really playing out and how it's going to be playing out in markets. Okay, without any further ado, Powell is still talking. The daily chart of the S&P 500 index, nothing going on down in here. In fact, I would say confirmation of the move coming from the momentum indicators. But when we look at the chart itself, I've been talking a lot about Fibonacci retracement levels because that's what you should talk about when you get a big decline and you get the inevitable rebound. If it's a bear market, I showed these areas here, the 38.2 up to the 61.8. It tends to be where bear market rallies go to die. You noticed we have pretty much failed right here so far. We had 2 days closing above it, and the 2 days since we're now falling below and bumping up against resistance at that 61.8% retracement level. We've got the 50-day moving average that we've recaptured. You lose that again, and the 200-day rolls over, and before you know it, we'll be testing these lows again. Doesn't have to happen that way. A tweet, if you will, out of the White House that we have a trade deal with somebody could very easily have this thing shooting back up, and we could move above these key retracement levels. Looking at the all-important NASDAQ 100 index or the ETF that tracks it, just looking at the price chart, failed right at the 200-day moving average. That's classic. Failed right at the 61.8% retracement level. That's classic as well. We could go a little further down, and you would probably find support right here. At least it would try for it at that 50% retracement and at the 50-day moving average. So this chart looks a little worse to me, frankly, than the S&P 500. Looks like we did fill the gap up here from the other day right to a T and found some support right at the top of that gap. The dollar, which I mentioned, is supposed to be going up when we're throwing out all these tariffs, and you can see anything but. Momentum is picking up to the upside while the market has gone down, so that's a bullish divergence. We'll see if the dollar doesn't gain some steam here. And it could be that the dollar does start reacting to tariff news. That all remains to be seen. Yields are coming down today. Our TLT, our long-term Treasury ETF, which is a core position, is doing pretty nicely today. It's up over 1.5%. And as the chairman is closing his commentary, the S&P is up 0.4%. So I think that's probably just kind of a relief rally that the chairman didn't blow anything up, presumably. And so yields coming down a bit, could be a reflection of the fact that the Fed, frankly, is not cutting interest rates soon. Therefore, the economy isn't going to get that support. Therefore, we are going to get the weakness, and therefore, interest rates are going to come down later. It is very counterintuitive. People still confuse Fed's action with lending rates in the broader economy, like mortgages, for example. The last time here last year when they cut the interest rates by 0.5%, everybody was wanting them to do that. And I was telling you here on the blog that our observation is that's actually going to push interest rates higher, and that's absolutely what happened. In no time, mortgage rates were a full 1% higher in response, in my view, to the Fed cut. Why? Because the Fed cut was coming at a time when the economy wasn't really showing the kind of weakness that justified it. Therefore, it was viewed as stimulative and put upward pressure on potential inflation and on economic activity. If, for example, the government tomorrow were to announce a bunch of tax cuts, I think you would see rates spike big time to the upside. Like I said in a recent blog post, they probably should wait till the economy is showing more signs of weakness before they come in with that fiscal stimulus, because then it'll be viewed as something that will help the economy as opposed to something that will reignite or fire up already too high inflation. And then lastly, our position in gold. So right in here, we got short-term bearish, and here we are testing that right now. It's down today, but that to me, folks, looks pretty classic, like a short-term, double top is what a technician would call it. And the way we look at the technicals, this is not a good-looking chart because we have bearish divergences on the momentum, and I've shown you this over and over and over again over the years. Never perfect, not always 100% correct, but this is not a positive look for that new high. You'd want to see that with at least the kind of momentum we had here, and you're just not seeing that. So this suggests that this will be a test that will fail and go lower. But if we hear signs that Pakistan is retaliating or India is throwing more missiles or what have you, that's what that big spike was. We got a 3 or 4% spike in gold, 3+%, I think, by the end of the day. That was, in my view, all about that missile attack that just freaked everybody out. Gold is where you'll go when you don't know what to do because you're afraid of bad things happening in the world. So something like that would have gold shooting up higher, but unless you think the world is coming to an end, boy, would that be a sell the news event. Now, having said all that, structurally, we are exceedingly bullish on gold. I'm only talking the short-term stuff and our concerns about our position there. So we're doing some hedging right now too, as we did in here, to mitigate, the lion's share of that impact, or something, that gold could easily, give you 10, 20, 25, 30%, pullback under the right conditions from these levels, particularly when you have what looks like a classic blow-off top right up in here. So testing that is normal. Just a heads up, folks, clients, that we're not buying any more gold right here, and we're going to protect ourselves from something serious, to what is, not a small position for us right here. So, folks, I got to go with that and save you from any more rambling. Thank you, as always, for watching and listening, and I'll be back later in the week or over the weekend. Take care. Bye-bye.